We're talking about trading tips today with Oliver Velez. Oliver, give us some ideas for how to profit from the current market volatility that's just been everywhere lately.
It certainly has, Kate. We've experienced obviously one of the most volatile months in years. I don't believe we've experienced this level of volatility since, 2008, 2009, when obviously the markets was under pressure from the financial collapse there. But volatility obviously is a double-edged sword. It can be a friend, it can be an enemy. For us, fortunately, it's been a very, very welcomed friend over the past month. It's been one of our biggest or most successful trading months of the year. So it's helped us in a way. And I believe that's it touches upon the strategies and the tactics that we actually have our traders deploy. We primarily use a 20-period simple moving average across all the asset classes we trade. And what we're looking for is any market that moves a certain standard deviation away from that 20-period moving average. Now, what volatility does is either volatility to upside moves it to a certain percentage above the 20-period moving average, creating an overbought situation which we play back to the downside, or volatility, excessive volatility to downside, takes the market significantly below that 20-period moving average, in which case we look for a snap back toward the mean. What we tell traders all the time is that a stock or any other financial item can get far away from its 20-period daily moving average, but it cannot stay far away from its daily period moving average. So after a certain standard deviation away from that moving average, we're looking for snapbacks toward that. We've had multiple moves above and multiple moves below that 20-period moving average across many markets during the month of August. So it's been somewhat of a friend to us.
Now, a lot of times traders and investors focus on the buying portion of the equation, but it sounds like what you're saying is you really have to be conscious of what the signals are with regard to selling as well.
Yes, I think we've left the world where you can get away with being a one-dimensional market player. You cannot play one market, you cannot focus on one time frame, and you cannot focus on one side of the equation. I think the market player of today is required to actually be multidimensional in his approach. And shorting is a very big part of this market. In fact, our traders make far more on average on the short side than we do on the buy side, simply because things fall a lot faster and harder than they rise. But I think a trader who's focusing entirely on the long side is operating with a very small part of the equation today.
Now, is there any particular time frame that you advise traders to focus on?
Actually, no. That's one of the things. We use multiple time frames. It does somewhat depend on the individual style of market play. However, we teach our traders that there are times when the smaller time frames are where the action is, and there are times when you should put the smaller time frames aside and focus on the bigger time frames, and those times tend to focus primarily in the trending markets. When a market is trending and flowing very smoothly and nicely to the upside or the downside for that matter, it's time to put away those smaller time frames and focus on the longer time frames.
Thank you so much for these ideas.
Thank you.
You're watching the MoneyShow.com video network.